Mark Haefele joins us now, CIO of UBS Global Wealth Management. Mark, good to see you. Looking at your forecast, your outlook for 2024, we're at 4,500 right now in the S&P. You've got softish landing for the economy, but very limited upside in the equity market, 4,700. Mark, can you help us understand that?
Yeah, I think there's a couple of things. First, we do prefer bonds to stocks because we think that interest rates are going to move lower, and that'll help the bonds. On the stock side, we're in a new world, and I'm not sure you necessarily want to focus just on the S&P 500. I think in both bonds and stocks for next year, we're looking for quality. We're looking for those companies that get that high return on invested capital. And so, you were talking about the tech, and we recently, about 2 weeks ago, upgraded the U.S. tech sector again, in part because that's where we're finding quality. And there certainly is, over the longer term, this kind of big is going to do better theme that we want to play on.
This is really important, Mark. When you look at the income statement or the dynamics to cash flow on the balance sheet, what is it about tech? Where on the income statement will we see that reaffirmation of quality? Is it sales off nominal GDP or off their plan? Is it down the income statement, gross margin, or is it use of cash at the bottom?
Yeah, I think it starts at sales, even though a lot of these firms are becoming more consumer-facing. One of the things that's changed so much about tech is you have more of these recurring revenue models in tech, which speaks to stabler earnings and earnings that can maybe grow as we get that slowing overall GDP growth. And then, of course, it flows from there down the income statement to produce more free cash flow.
I just think about this article talking about automated capitalism over the weekend, which is essentially the revenue streams that you're talking about for some of these tech names, like, for example, Apple and the Apple Store. You talk about how big is going to be better going forward, Mark. Does that mean that the Russell 2000 you can just basically leave for dead after one of the worst underperformances going back decades this year?
Well, look, we think that we're going to have a softish landing, and then I think in that scenario, some of the more dire predictions for what happens with the small caps and that they can't refinance and things, that goes away. So I'm not making a super dire prediction on small caps. I think the point is, where in the past you would think, oh, these large tech companies in AI can't keep growing. But what's so interesting, is that actually these firms that own such a large portion of the value chain now, and get those insights that can train these AI models may have an enduring advantage despite the fact that they've been up so much this year. And so that's one of the reasons that we upgraded the U.S. tech a few weeks ago.
And are you leaning more into the AI names, right? I mean, tech is not all the same in terms of whether it's Apple or whether it's Microsoft. Are you bifurcating some of these bets, or are you just saying all of them are going to be winners regardless of their niche?
Well, I think there's a couple of slices at this depending on your time horizon. I think, over the longer term, one of the most exciting things is that the AI will broaden out, beyond the tech names and could potentially lead to certain disruptive companies having stronger margins. And so we're on the look for that. In the very short term, I think one of the things we're looking at is that actually, chips can do better here as well. So we're looking, say, beyond just software, but also at hardware at this time.
Mark, does this remind you of the internet boom? And do you see it playing out the same way in equity markets, that you get this sort of frenzy and then only a few win?
I think about that a lot. I think that was somewhat different in the sense that, what we're specifically talking about now is quality, and we're talking about free cash flow. And free cash flow was not what we were talking about in the internet boom. That was about eyeballs. I'm old enough to have lived through it and make this comparison and force the team to look at this a lot. But I think we are finding some real differences.
I want to know, what we're going to do with this wall of cash. Lawrence McDonald talks about it, one of my essays of 2023. And Mark, we all know there's a ton of money out there, but does it just sit like a lead brick, or does it actually finally get put to work?
Well, we're urging our clients, and I think they're starting to understand that right now you can get these tremendous yields on cash, and so it's hard to move that cash. But as these rates start to come down, I think that will start to move this wall of money, and some of it can go into supporting the equity markets, and some of it can go into supporting the bond markets, and some of it can go into private investments and alternative investments as well. And that's why we think this is a great time to get your portfolio in balance back to what your asset allocation is, and maybe forget about rates going negative again and really think about what does a proper asset allocation look like.
I think we all hope we don't go back there anytime soon. Mark, thank you, sir. Mark Haefele there of UBS Global Wealth Management with their outlook for 2024.